Hello and welcome to this ICIS Energy LNG Outlook for 2017. I'm Ed Cox, editor of our global LNG portfolio.
And I'm Josie Shillito, deputy editor of Global LNG.
And we're going to be looking at some of the big themes that will affect LNG and the global gas market in 2017, with a particular focus on production, imports, demand and also shipping. So 2017 will be another dramatic year of change for the LNG market. We're expecting over 44 million tonnes of new production, particularly from Australia and the United States, in what is a trend that started in terms of new production back in 2015. So if new supply comes online on time, the market could well be oversupplied. But as we saw last year, a lot of new production, particularly in Australia, saw several delays, which ultimately reduced the impact of new supply coming to the market. So last year, our analysis shows LNG production was up about 7% year on year. This year we could see a rise more between 17 and 20% if new production starts online on time. And the change this year is really that United States exports from the Gulf will increase and come online, particularly from Sabine Pass and also from Cove Point, steadily moving the emphasis on new production away from Australia and the United States. Looking further ahead, it's hard to see that new investment decisions in export projects will really flow through quickly, with oil still relatively low in price and questions over LNG demand, but we'll be keeping a close eye on projects such as Mozambique and also Equatorial Guinea, where there is some momentum behind potential new production in terms of floating LNG options. So potentially a lot of change in terms of production. Still questions over demand, particularly from the large importers. And Josie, can you tell us a little bit more about that?
Yeah, so the demand profile is changing in LNG. What we're going to see in 2017 is the baton held by the traditional buyers in Japan and China, handing that demand baton, so to speak, over to newer buyers, and that's going to be centered more on India, Taiwan and the Middle East. What we've got with China and Japan is over-contracted capacity. They've got too much LNG coming to them, and they're going to be looking to carry out deals to either divert that LNG or to swap it, maybe with demand areas that need it more. Some examples of China and Japan already trying to get rid of their over-contracted capacity can be seen with some deals like EDF Trading's deal with Japanese buying consortium JERA. That's a trading company in France that's doing swapping some volumes with JERA, taking those US volumes and taking them into Europe rather than sending them to Japan. We'll probably see more of those, and in India, which will be several million tonnes under contracted, so new demand, there'll be some spot demand from there as well. But you will see companies like GAIL, which is one of India's biggest buyers, coming to the market with spot demand, but after 2018 possibly doing this less because they're looking to swap some of their excess capacity from the US after this point. But certainly for 2017, some Indian, some Taiwanese demand. The other interesting area for LNG demand outlook is the Middle East. We've seen new buyers come to the market in recent years, Jordan and Pakistan, to name two of them. What we're going to see in 2017 is Egypt possibly come back to the market as an LNG exporter, certainly in 2018, and so can satisfy some of that Middle Eastern demand, possibly along with traditional suppliers like Qatar.
So there are a lot of questions 2017. It's quite likely the market will be oversupplied. We may see new buyers coming to the market if spot prices fall back below to $5, $6, that kind of mark. But the year has actually started in a quite bullish manner, with Asian prices coming close to $10. We'll be keeping a very close eye on some of the old long-standing plants that have had production issues last year, such as Trinidad, and the price of oil, which ultimately dictates a lot of sentiment and competing fuel prices in countries like India and the Middle East. And if oil prices do shoot up, contractual LNG prices, which are predominantly linked to the price of oil, will go up, and you could see a divergence between contractual LNG prices and spot LNG prices. So there are a number of different dynamics going on, and one of the most interesting things will be the change in the shipping market, with new vessels coming to the market and new trade flows coming. So let's close by having a few thoughts on that, Josie.
Yeah, things should improve for shipping. Shipping's had a really horrible 2 years. There's been too many ships brought into the market, new builds, and not enough LNG to carry on them. This is going to change in 2017 as production ramps up, because it's slightly out of sync with the volume of new shipping supply now coming to the market. It's going to get a bit tighter, charter rates are going to go a little bit higher. What's interesting is how high can they go? Can they go to $120,000 per day, which we saw a few years ago? Or is this actually impossible now that oil has fallen so low? Is that going to put a cap on charter rates? Because can people just switch to a cheaper fuel now and not use the LNG? So we'll be looking at that. What's true is companies like Qatar Gas and Rasgas, the Qatari suppliers that are merging, and Shell and BG, which merged this year, are merging gigantic shipping fleets as well as merging gas production capacity. So we'll be able to see more optimization and more swaps going on with shipping as these companies try to make the most of their vessels and try to limit vessel idling times when they're dealing with such large fleets.
Thank you, Josie. So any number of things to look at in the LNG market. We'll be keeping on top of all the key issues. For more on our services and products, visit our website at ICIS.com.